It's my pleasure to introduce Tim Koch. Tim is a distinguished professor emeritus of the Darla School of Business at the University of South Carolina and president of the Graduate School of Banking at the University of Colorado. So I have a special affinity. Do you know I live in Fort Collins now?
No.
Yeah.
Welcome.
So just down the road, if you ever need any speakers, just give me a call. I still work here, though. So anyway, he has literally written the book on community banking. His book, Community Banking from Crisis to Prosperity, is a guide for bank directors and senior bank managers. He has a Bachelor of Arts degree in Mathematics and Economics from Wartburg College and a Master's degree in Economics from Purdue University. He also earned his PhD in Economics from Purdue University. Tim, thanks for joining us.
Thank you very much, Julie. It's my pleasure to be the moderator in this panel today. I think you're going to find three fascinating papers. I did ask Jim earlier if I should give you a trigger warning, because you are going to hear words that might make some of you community bankers a little uncomfortable. Things like credit unions, mega bank acquisitions, bank scandals. But I think the focus on competition, particularly in deposit markets, you'll find fascinating. Do follow quite interestingly with what Governor Quarles just said. And so we're going to follow the program. First, Rodney Ramcharan from the University of Southern California is going to speak. Then Troy Kravitz with the FDIC, Mika Homanen with Cass Business School in London, and then our community bank discussant is Gilda Noguera from East Cambridge Savings Bank in Massachusetts. So, Rodney?
Thank you, Tim. So I'm going to try to stand over here. Perhaps that's a little easier. So it's a pleasure to be here, indeed. It's always a dangerous task to talk to an audience that knows more about the topic than you do, but I'll try. So this paper, the presentation, is focused on it's a policy question that's been around since banks, and it's what's the impact of competition on the banking system, and what's the welfare consequences of that? And people have been thinking about this, as I said, for hundreds of years. And I think if you try to develop a consensus on economic theory on this question, the answer is generally ambiguous. So on the one hand, you have people saying that more competition is generally good. It causes banks to get more, to be more efficient. It lowers the borrowing costs that individuals incur. It tends to increase the deposit rates as well. And it tends to lead to a more stable banking sector. So these are all the positive things. And then I think so the idea has been around since the Depression. But in the 80s, some famous papers began to make the point that more competition also has a negative impact on bank profits. And the decline in profits and the loss of franchise value can sort of cause bankers to take on more risks. And that could make things worse as well. So you have a contrasting set of theories. And so people have been thinking about this. And the idea has been, if you look at the data, a fair way to summarize this data is to say that the findings tend to be fairly context specific. So lots of studies have looked at this, and some have found, say that in the period before the Depression, banks that were subject to more competition actually did better. And looking around the same time, people have found as well the opposite. They have found that in areas where you had more banks and more competition, that may have been a propagating mechanism for the Depression itself. Okay? And then looking at the crisis in the last 10, 12 years, there's been a great deal of work that makes the case that the competition between the non-banks and banks might have led to the crisis in terms of the sharp rise in house prices. So a fair statement would be that the theory is ambiguous and the evidence is also mixed. And part of that is because if you care about making causal statements, and I used to work at the Fed and I understand how difficult it is to know something because you get lots of data and it's very hard to look at all the data and sort of try to find out what's the causal factor, what's driving things. And in this instance, one of the key impediments is that banks don't sort of randomly enter a local market. And so trying to study the effects of competition means you got to control for the factors that precipitated entry in the first place, because those factors are going to shape outcomes. And if you don't do a good enough job of trying to tease out these things, then your inference could be wrong. So what I do in this paper, or what we do in this paper is, and many of you know this really well, that the credit unions beginning since the mid-70s, there's something called a low-income rule. And if you're a low-income institution, or if you meet the criteria, then all of the standard constraints on competition for that institution is done away with. So if you're a credit union and the NCUA, which is the regulator, says that you meet the criteria, then you could effectively compete freely with the local banks. And typically, the existing rule, or the rule up to 2008, had been in place since 1994, and it was a pretty cumbersome rulemaking. And so from 1994 to 2008, there was no change in that time in entry into low-income status. So it was a fairly static thing. And one of the key impediments is a credit union had to go and apply to the NCA and provide lots of data. And the NCUA, beginning in 2008, wanted to deregulate and allow these institutions to expand. And so what it did is it said, we're going to make it easier for credit unions to become low income. And there's a whole background behind it that's in the paper, but what I want you to keep in mind is the way they did that was they said, we're going to automatically check at the time of the bank exam whether you meet the criteria. And they've changed the way the criteria is set. And so this was quite complicated for a long time, and so they didn't finalize the rulemaking until maybe 2011. And the industry still was not aware of this, and they sent a letter out in 2012 Q1 that says, guys, you now can qualify for being low income, which would allow you to compete. And so beginning in 2012 Q1, you have a huge increase in the number of credit unions that would meet the designation. And then after that, from 2012 Q1 up to a couple of years ago, the incremental change begins to take place with the bank exam. Now, in terms of magnitudes, that's on the left-hand side. You're talking about effectively a 1,500 in terms of the number increase, and in terms of quantity, in terms of assets, it's about $400 billion. So you effectively have, over that time span, a $400 billion bank that is now allowed to compete much more freely across space. And so in the analysis, what we do is take advantage of the variation that comes about for the timing for when these guys are allowed to compete. I don't have a whole lot of time, so we do a lot of tests to sort of document that this thing is exogenous or effectively random. The one takeaway is what you're looking at is a picture of lending growth after a credit union gets designated as low income. So the period before is on the left side, on my left here. So you see there's no impulse in lending before they get the designation. After they're designated as low income, there's a substantial increase in lending that tends to persist. If you look at the data out to more than 1 year after and beyond, you're talking about the average lending growth going up about 20 basis points per quarter. Okay, so in terms of dollars, it's quite sizable. The dotted line or the gray lines are the confidence bands. You don't need to worry about that, but it's a statistically significant fact. So then what we do is we want to measure the response of the community banks to what is effectively an increase in competition. So for each of the community bank in the data that we have, which comes from the FDIC's list, we draw a 5-mile circle around the headquarters of these banks. That's the red star. And then we look at the variation in when a credit union turns on and is allowed to sort of effectively compete freely. And that would be the green star. And we're looking at that across time. What we find is that in response to the increase in competition from the credit unions the smaller banks generally accommodate entry. So what I mean by that is they pull back on lending. So they're effectively allowing the credit union to expand by contracting their balance sheet as well. And so these dots represent lending growth at various quarters out from when a low-income institution gets going inside that census tract. Okay, so that's fact one. There's a lot of work where we look at interest rates and so forth, and we find generally positive things, so that the interest rate that a depositor gets tend to go up. We look at bank failures and find that the community banks are more likely to fail when exposed to the competition from the credit unions, and we find that the differential in failures tend to be higher in the higher tax states. Because the low-income guys are tax exempt, and so if you think that this is coming from the competition, the effects of the competition are going to be much bigger in the high tax states. Now, the aggregate data is sort of not perfect, as you well know. So my colleagues and my colleagues at the Fed, they looked at data from Equifax, which is, I guess you know what Equifax is, and we look at car loans. So we can identify every individual car loan, and we can identify who the lender is, as in if it's a credit union, a non-bank, or a bank. And what we can then do is look at this at the extensive margin, i.e. try to document when credit unions expand into a zip code or into a county, is there an increase in car loans? And then who is doing this increase in lending? What we find is that when a credit union expands into a zip code, there's about a 27 basis point increase in car loans being made. A lot of the action in those loans are coming from the credit unions themselves and from the non-banks, that is the captives and the shadow banks. So the banks, again, tend to seed this market when competition goes up. Now, a lot of the debate about competition gets said as it could lead to a misallocation of credit. So that if you have competition and entities are trying to protect their market share, one of the ways that they can do that is by going down the credit spectrum. And so the arguments for the crisis of 2008 and 9 was that competition led to the expansion of subprime lending. So Equifax gives us the credit score of individuals, and so we could disaggregate our data and look at where on the credit spectrum, when competition increases, where on the credit spectrum does this stuff go? And we do that here, and so this is the first quartile of the Equifax risk score. So these are going to be the subprime guys, so people say 660 and below. And what we find is that virtually all of the action takes place there. So what I mean by that is when credit unions expand into the zip code, into the area, there's competition for market share. Banks, the smaller banks seem to cede that space. And there's a significant expansion in lending to the subprime folks, both by the credit unions themselves and by the shadow banks. These are the non-banks, again, the captives. You could break it up to different quartiles. I'm sorry for the density of the table. What I want you to take away from the table is if you look at the prime space, so these are the people with really good credit, there's no competition in that space. Okay, so the broader point is that, again, when competition expands, a lot of the credit is being driven down to the subprime. We have data as well on the default rates of these folks on these car loans in 2016 and 17. The key takeaway, and again, the table is a little dense, the key takeaway is after exposure to competition, default rates go up. They tend to go up significantly amounts to subprime. They tend to go up significantly amongst subprime loans made by the credit unions and made by the non-banks. Okay, so that's the key takeaway in that slide. So I'm almost out of time. So I think just to summarize what we've done, we've used NCUA regulations or changes in those regulations to, as it were, construct a natural experiment. Look at the variation in credit unions' ability to compete with local banks. And the general point is that the timing of those bank exams are exogenous and not driven by local economic conditions that's going to conflate things and make it difficult to make a causal statement. What we find is that the community banks generally accommodate entry when faced with the competition, and they shift their lending. So there's lots of stuff I didn't show. They shift their lending into the C&I space. And the non-banks, these guys don't have a whole lot of alternative lending to do. And so when faced with the competition, they fight back and they fight for market share. And a lot of that gets driven down into the subprime space. Now, what we don't know is whether this is a classic misallocation of credit. So what we don't know, and I have no data to tell you that, whether these loans are not net present value positive loans, but they're still being made, like what took place during the crisis, we don't know that. What we do know is that the non-banks are going to take these loans and they're going to try to securitize them, and that's what they do. These are off-balance sheet things that are going to be spread through the banking system. And so to the extent that people are not necessarily paying attention to risks, this could be a potential channel as well. And I think the final point I'll stop on is there's a general sense in supervision that we could reap the benefits of competition if we supervise better. But if the activity is being pushed outside of the supervised space, as this seems to indicate, then that hook is not there, right? So I'll stop on that note.
Thank you, Rodney.